very happy new year to everyone, and best wishes for the year ahead. Uh, I hope everybody is healthy. Today's call, I am going to follow a little bit the format that we've been using. I'm going to have a bit of an overview of last year and the risk, also the outlook and the portfolio in some detail. I would like to keep it big picture also. I think it's easy to get caught into the very short term, and so we'll have some overview of the big trends that we are witnessing at the moment. I'm gonna silence everybody, and please, if you have any questions, feel free to post them in the chat as always. And look forward to getting all your questions and discussing in more detail. So let's start first looking at the historical performance. Obviously, we've had last 2.5 going on 3 years have been very eventful. We've had some periods of turbulence when the strategy is done very well with meltdowns, and also we've seen some extraordinary rebound, and I think everybody's familiar with obviously what's been happening since March, April last year, and we're overall in a situation where despite all this volatility, we've seen how U.S. equity markets have once again led the charge. We have the Nasdaq there, we have the S&P in orange, and how Igneo has actually done well throughout this process overall, and it's done it with a completely different path. This idea is something that I emphasize a lot. Is this the mandate is different, whether you are a striker or a goalkeeper, and it's challenging to stay ready for these adverse moves, especially with the large degree of distortion and manipulation that we're seeing on interest rates and liquidity. But I think more than ever it's important to keep these very diversified teams and do it in ways that will be hopefully as predictable as possible. Just having a look first at Igneo on a standalone basis, the year finished about 13.3% net, which contributes to about 23.3 since launch, and it's done it with again quite remarkable and a contribution from different buckets. What you see in this slide is the attribution of that P&L in terms of the different components. These components have had are diversified between themselves, and we see how core precious metals and treasuries and the options buckets have worked throughout the cycle. I'm pleased that we ended up the year reversing a little bit of the difficult run that we faced, and we discussed in a lot of detail the dynamics that led to some of the drawdowns. So with that, moving on to, and again looking at these periods, again the big contribution from the options buckets and how this more challenging period we faced lately. These materials, for those who are interested, I'm happy to share after, and I think here you see the same information in terms of how the attribution, particularly of the options bucket, has taken place. And interestingly, if you think about the exposure to some of the gold upside, I think since we saw historical highs in basically in during the summer, we've seen how gold had a very difficult run, which in my view stands out clearly relative to many of the things that we're seeing. A weaker dollar, very strong inflationary pressures representing coming through higher equities, and obviously Bitcoin and other things that have gone crazy, and yet all this narrative of a weaker dollar and inflation, and Bitcoin for the has not reflected in gold. I think this is an anomaly. We continue to see a move back to historical highs as a matter of when, not if, and we think it could happen and break significantly higher. So in terms of the attribution, yeah, we see how some of these mark-to-market losses on gold options, I would say, is largely mark-to-market. It's money, I think, in the bank, in the sense that many of these are have months and years of life ahead of us. We see also how net the insurance bucket coming from equity puts was obviously a huge contributor during the big sell-off in Q1, and has been giving back some. But we continue this disciplined approach where we are buying and continue to restrike and play for lower equities and higher VIX. Obviously very challenging when the market is one way. I've even had investors saying, Diego, why do you even waste money, buying puts on the S&P, and things that, if anything, just reinforce our view that the market is extremely complacent, and we need to, we see opportunities to accumulate this insurance, although the carry, it's a consideration. We've been buying puts on the S&P and calls on the VIX, which might be the right idea. We've had the wrong outcome, and this is something I discussed at length. The decision versus outcome. We're very focused on the quality of the decision process and competing our mandate. So with that, we continue to see a need for the goalkeeper and what we do. You're familiar with this. Some people might be calling in for the first time. I think it's critical, again, to have this mindset of a team and the process. And I have these 3 stages which I think are critical, which is what strategy do you want to play? Do you know how many strikers, midfielders, goalkeepers? That's part of the game, and most people, or many people, have suffered from false diversification. They only have strikers, and this comes at a price. The second piece that is very important is obviously, okay, once I decide how I want to play, which specific players do I pick? And here, we, as a humble defender or goalkeeper, we're trying our best to do our job. And I think within our group and within our mandate, there might be people who also do this and diversify further. But I think what we do and how we do it is pretty unique. The third role, and this is incredibly important, I'll emphasize this again, is the performance of the team is not just the performance of the players. It's not a weighted average. The idea is when you actually rebalance these teams, the team does significantly better than the individual players. And this is something that the eye doesn't catch. But when you run the numbers, and we'll talk about this in more detail, it's clear. So beyond the individual merits, we need to think about as a team, because ultimately, as I always say, the 2 rules of this game is protect the capital and compound. And this is obviously something we want to do at the individual strategy level, but this is a team game, a team sport. So it's not, diversification doesn't come because by asset class. In football, you could wear a t-shirt with number 7. It doesn't mean that makes you the best player in the team or a striker. You are what you are because of the way you behave and how your mandate. So with that factor, you've seen this before. Our strategy is clearly designed and behaves with a defensive mandate. Of course, we won't do that great during very, very bullish markets, but it can offset that with these big saves. And when you think about this kind of profile, this is, for those who see this for the first time, is what we call the avatar. This is effectively spider analysis, where the middle scores 0, the outside is a 10 out of 10, and we see how strategies could be synthesized in terms of their defending power versus offensive versus alpha generation. And when you think about putting together the team, and this is perhaps the simplest portfolio, with just a goalkeeper and a striker, you see how the avatar at the bottom left for the goalkeeper is very defensive. The avatar for the striker on the right is very offensive. But when you actually put the team together, you get something quite powerful. And that quite powerful is, you know, the simplest way to understand the team is the weighted average. But it's important to see this how these pieces offset each other and how you're able to achieve if you combine two pieces with positive expectancy and negative correlation, good things happen, right? And this is what happens when you get the passive basket. The 50-50 basket would have generated the weighted average as expected, about 31% in a 50-50. But the more important thing is what happens when you actually rebalance these baskets. We've seen this negative correlation, meaning that the 50-50 basket has moved from 50-50 to 60-40 to 40-60. This is about embracing the volatility of the market. It's about embracing the stupidity of the market, in my view. And you want to stay in those pieces, but rebalance back. And effectively, by simply bringing your portfolio back to 50-50, effectively buying cheap, selling expensive, or selling expensive, buying cheap, we achieve what it would be a rebalance basket. What we see here quite clearly is that incremental return that comes from effectively just passively rebalancing the portfolio. This is just monthly. You could do it by time. You could do it by price trigger. Ultimately, the idea is a systematic process that seeks to take advantage of the volatility and embrace that volatility rather than fighting it. And here we see that incremental return would have been 6%, which means that you're making money whilst you sleep, because you're not trying to predict with a crystal ball, oh my God, these guys are geniuses in March, or these guys are total losers in later on. It's the role of the team and how you take advantage of that exuberance or over complacency or panic or greed. And we are just doing our job, and I think we're well positioned to continue to do that. And I think it's going to be very challenging periods ahead. I know 2020 was a terrible year for many people, and we're all hoping that 21 will be back to normal. I fear 21 is going to be also a roller coaster. So we'll see how it goes. But I think this becomes even more clear for those who have an equity mindset. You see clearly that instead of having the S&P, if you actually build the team, you're able to achieve pretty much comparable returns with a fraction of the risk, even if, of course, you're still subject to potential drawdowns. So I think this case of not just having strikers or goalkeepers and understanding how what strategy you want, which players that you put, and how you rebalance. I think it's being a contrarian. It's very much at the essence of what we recommend and what we've done. With that, I'm going to move into the outlook. And as I said at the beginning, I'd like to keep a big picture because what's happening is really is pretty major in terms of transformation. So ultimately, we are in a situation where the global markets are highly distorted. We are seeing unprecedented levels of monetary policy and fiscal. And what is done is transformed, as I always say. Over the last decade, we've seen the transformation of what was once upon a time, risk-free interest into interest-free risk. This has very deep implications for portfolio construction. And the first one is that there's no such thing about risk-free interest anymore. So we are being financially bullied by central banks who are basically putting a gun in our head and saying you're stupid by holding cash at zero or worse or negative. And this is something that as money digitalizes, it's going to get even worse. So there's nowhere to hide in a way. The second implication, and if you had instead of cash fixed income and you're looking at 10 or 30-year bonds, obviously at negative nominal yields, the ability to defend is limited. Once you had your 10-year bond or 30-year bond at 5% yield, if there was a crisis, and yields went to zero, your bond would make huge gains. That orange has been squeezed already. That 60-40 balance portfolio is, as a result of this transformation, is no longer working. So 60-40 balance portfolios are no longer balanced. There is these correlations have broken, and fundamentally, we have a big issue. So we have to look for different ways to balance back the portfolios. And the third problem that emerges from this, which is clear, is the fact that when interest rates are artificially low in nominal terms, and obviously also through credit spreads with monetary policies without limits, we also see that asset prices are artificially expensive. I talked about this before. If the present value of $100, in 50 years' time, if someone's going to pay you $100 in 50 years with interest rate at 5%, that will be worth 8-9 cents today. With zero interest rates, is worth parity. So the reason why Tesla has a 1500 PE and things like that is partially driven because of these benign expectations of the future, but also the discounting and the impact that it has on PEs, etc. It's all highly distorted and manipulated, and it creates a big problem. So my view is that we are facing bubbles without precedents. The systemic risk is huge. It's a house of cards. The whole crypto space, which I'm not gonna probably debate on the Q&A if you're interested, but that's just broken $1 trillion. That is, as far as I'm concerned, money out of nothing. It's the emperor has no clothes. People feel very rich. It doesn't exist. That $1 trillion does not exist. It's a pure wealth effect. And this is very much back to 2001, the perception of wealth. But as far as I'm concerned, that's worth zero, or at least, and I'm paraphrasing Ray Dalio, the intrinsic value of money is zero. And that's a really big statement to make. What matters is our goods and services, and money is that intermediary space. And I think the ability to store and preserve, it's all been challenged. But I think what we are facing phenomenal bubbles, and I think 2021 will expose some of them, which means that the fragility of the system is such that if we were to normalize monetary policy, and this is one of the biggest debates that we're seeing today, I mean, the 10-year US Treasury, as I looked, it was 106. People are already trying to discount the expectations of when is the first hike going to be, and are we going to normalize monetary policy? As far as I'm concerned, this is science fiction. Okay, we're not. And I don't think we will be able to normalize monetary policy and hike interest rates without exposing the ginormous bubble that we've built across everything. So in that sense, the market is in this twilight period where some of us think, look, this is artificial, it's all highly inflated, and if you remove the support from artificial interest rates, it all collapses, where some people think this is just normal. So I think, once again, I'm a big fan. I don't agree with him entirely, but I'm a big fan of Ray Dalio and a lot of the work. And I think his historical perspective and his multi-decade and multi-generational, multi-century approach is helpful, because some of us who may have been around for less long, some of these issues are once in a lifetime, as he says, but we've viewed them before. So I think it's really, truly extraordinary where we are. Things are accelerating, but I think we shouldn't fool ourselves. These cycles are repeating themselves, and this is something we've seen already. So as a consequence of what I'm discussing, I think I feel strongly that we are, and I've said this in the middle of the crisis, is nothing new. I think the way out and what's coming is very, very high inflation. Unfortunately, more likely to be stagflation, which is effectively the worst case scenario in terms of high inflation and without that real economic activity. A lot of the trillions that are printed and might be going into just people's pockets or infrastructure, it's at the price of debt, it's at the price of inflation, and I think this is the way out. So we know the system is fragile. We know we've had a shock without precedents, which, by the way, is still going. I'm not going to touch too much into the vaccine, but it's very much priced in that everything's going to be okay, and I hope that's the case, and all the vaccines work and we'll be able to normalize. But there's significant risks in the system that are not over. But what is clear is that the monetary and fiscal response that we've seen is without precedent and has resulted in total disconnection between the economy and the markets. This makes things quite challenging. If you look at things from a conventional basis, and it creates a lot of problems for those of us trying to figure out if 2 plus 2 is indeed 4. But if you think about all this liquidity and debt, it's clearly not, in my view, solving the problems. Liquidity and debt will not solve insolvency, and of course, whilst there's many things happening at the same time and big opportunities emerging from new technologies and others, we have a situation where there's big problems already there in the form of zombies and companies that are already dead. I talked earlier about this idea about, and I highlighted it in yellow because I think it's one of the key points that the market is focused on today, which is, can we really hike interest rates? I think this might bring us back to a situation like Q4 2018, when, if you remember, Powell was talking about being in autopilot and just normalizing things without realizing that as you did that, you exposed the bubbles. And basically, we know what happened. We had a big shock, and since then, the central banks have been in one-way mode, effectively trying to prevent things from collapsing. And I think we might see that again. Call it tantrum, call it whatever you want. I think higher interest rates will expose the bluff, basically. So we know and we hope, as I said, the virus will go, hopefully with the vaccines, hopefully soon. But we also know that MMT will stay. The checks, the money printed, the debt, everything else is not going to be unwound. To paraphrase Powell, they're not even thinking about thinking. It's just that stage. Even if you have equities are all-time highs, etc., which shows you the great disconnect. And my point on inflation as kind of the way out. A big sign of warning, because I think financial valuations that are artificial will not last forever. And I think, I don't have a crystal ball, and many people might be feeling and the same concerns as I have. And then I often get like, yeah, but the next 6 months will be okay, maybe towards the end of the year. No? And those of you who are in Twitter, there's a really awesome guy called Sven Henrich, I think is his name, Northman trader. And I loved his tweet from this morning who said, markets are forward looking, but they always miss what's coming, or something like that. So yeah, we're trying to think forward looking, but we always miss all the crisis. Somehow they catch us by surprise. And I think this dynamic of timing, etc., is very, very difficult. The narratives are very powerful. The US, unfortunately, had over 4,000 people dying yesterday. Obviously, nobody cares. But there are very severe things that are there, and these valuations and growth and Teslas and others are just challenging the many of the things, and I think will normalize eventually, but difficult to fight them. So I'll have a special section on bubbles a bit later. Complacency, fear of missing out, there's no alternative, etc., continues to be an issue, be it Bitcoin or whatever. The dollar clearly, in my view, at the center of a lot of what's been driving the market since, for most of last year, and how the change from the Fed in terms of inflation, where 2% used to be the ceiling, and now it's considered to be an average. I think we're already, last week, we saw 10-year break-evens above 2%. This thing is accelerating, and it's going to test this bluff. But clearly, for the time being, a lot of consensus on a much weaker dollar, which we agree with the general direction, and we think that it should lead to much higher gold in particular, which is lagging. But we also know that Europe and Japan and Switzerland and China and others are also going to do the same. And in fact, they're already doing the same. And Europe, if you think about the size of the fiscal package, it's huge in absolute terms, but is even bigger than the US in relative terms. Yet euro dollar pretty much one way and very consensus. So we think that gold eventually will stand out, not just versus the dollar, but everybody else. And there's some lagging to do, and we're positioned to benefit from this. Yeah, I think increasing talks about monetization, although I think it's still very early days. And China, very interesting. Nobody cares. It's actually seen as a big winner from everything that's happening. We've seen major inflows into the Chinese government bond, which is considered to be almost free money. You get your 3% for 10-year, and which means you have plenty of carry. And then if it's a good story to build, and then on top of that, you had the appreciation of the yuan. A word of caution, because China, we think that all the dynamics that we're seeing, you don't need to be I don't need to put the full list out, but the world is once again going into some kind of I think Cold War equivalent, with more complex, but clearly the China developing their own web, developing their own access, developing their own links, alongside with many of the issues that we're already seeing in Hong Kong, in Taiwan, Jack Ma disappearing, 50 people being convicted or taken in Hong Kong. I mean, death penalty for this gentleman, etc. Plus, let's not forget, China, in my humble opinion, is the biggest credit bubble in financial history. So a lot of what's happening there will eventually manifest itself in a weaker yuan. And whether, obviously, you have two opposing forces with the dollar, but we have a significant amount of insurance in case basically China and or Taiwan, things were to deteriorate and the currency gave way. So we see that as a big tail risk, geopolitical as well as economical, that most people seem to be ignoring, but where we see a massive opportunity with incredibly attractive risk reward. It's been painful, and some of these options have expired. Many of them are still alive, but certainly we think that that's an area to keep an eye, and this is a very good entry. When it comes down to volatility, we are strongly positioned for an increase in volatility. We've shifted a little bit of our exposure away from puts on the S&P, more towards basically call options on the VIX. We think the volatility of volatility is going to be very high. We've seen how incredibly, let's say, the vol of vol, the moves in the VIX are for relatively small moves in the S&P. We're already seeing a very jumpy VIX, 3 or 4 points with 1 or 2% moves in the S&P, and we think that there are significant asymmetries, and so we have a core position built into the VIX, which suffers from negative carry, and you need to play around with what's the optimal way to do it through a combination of maybe futures and options. But we think that this is a very important defender to have in the portfolio, and the negative carry needs to be managed and offset. But we think volatility will remain high, and there's a risk of much higher spikes. With that, moving into something that just the pillars of the macro view is this idea, this misconception that you can actually solve problems by printing money. You know the drill, you know everything that is taking place, and it keeps being expanded as we speak. But ultimately, the key thing is to understand, in my view, that we're not solving problems. Okay, let's not fool ourselves. We are doing 4 things. We're delaying the problem. We're kicking down the can in the form of debt and with liquidity. The second thing is we are transferring the problem in the form of currency wars. So the US is now passing the problem to others, which of course will defend themselves. The third thing is we're transforming these problems from bubbles into inflation. And the combination of these things, kicking the can, transferring and transforming into currency wars and debt and inflation, means that we are enlarging the problems. Some of those might be less direct for global markets on first instance, such as inequality, but they're real problems. And some others will actually kick into and accelerate as things accelerate. So as you know, and we'll talk about inflation in a minute, it's not just about inflation in itself, it's also about inflation expectations and what that means. So from a fiscal perspective, this has become forefront. Markets yesterday took a very complacent view of the blue wave, where, as you know, with 50-50 and the Democrat vote, taking that balance gives more room for changes. But this is something that the market views as, okay, we're going to get our $2,000, we're going to get more fiscal, we're going to get more spending. This is all good news. It's somewhat ignoring the other side of the coin, including rises in taxes, both at the reversing previous moves, corporate and others. We think this is something that it's a meaningful risk, but the market is sort of staging the impact and trying to assess what can be done with 50-50, what requires at least 60. And in that sense, again, the complacency continues to dominate the markets. So be careful with that. It's again the flip side of the monetary policy and how we are trying to do whatever it takes to prevent the collapse. Also, just sharing some of my reading, very interesting book from Mervyn King, and talking about radical uncertainty. It's very humbling to see someone in his position to basically put things out and publicly acknowledging that they had, pretty much there's certain circumstances where you have absolutely no idea where you are or what your actions will imply or what will happen, and that's a little bit of what we have in terms of experiments. So I think the fiscal, the historical perspective of Dalio, I think it's powerful and has very important implications. So what's happening monetary and fiscally, it's clearly leading, in my view, to the third key point I want to re-emphasize, which is the deflation versus inflation debate. And here again, there are lots of deflationary forces in the system, whether it's unemployment, economic activity, technology, overcapacity, malinvestment, zombies, all these things is demographics, all these things are hugely deflationary, but there's one single force on the other side, which is money printing, which is effectively offsetting them all and more. In the short term, it creates a sense of stability because you're avoiding deflation by printing money, but effectively this is something that is not, as I mentioned over and over, not solving the problems. It's actually, in my view, creating different ones and moving us into a new paradigm. So this new paradigm, I think, is accelerating and will continue to dominate global macro for the next 10 years. So be careful what you wish for when we talk about inflation. So I mentioned this in the previous call, using Ray Dalio's sort of checklist of bubbles. I think it's, if you go through them, we pretty much tick them all. So interesting to see all these dynamics over and over, and we'll see how they finish. And I'd like to, perhaps before we move to Q&A, touch on the portfolio. I already discussed some of the dynamics. For those of you who are not familiar with the strategy, just a brief overview. We have three key building blocks: core precious metals, treasuries, and options. On the precious metal side, we have a target of about 50%. On the treasuries and tips, we have about 25%. In both cases, no shorts, no leverage. And then the big component of the strategy with a target of about 25%, it's the long-only insurance, where we're basically looking to buy puts on, call it bubbles or risk assets, and call options on anti-bubble or anti-crisis. With this framework, which is very systematic, we have a number of candidates in the different players that we can select to help us achieve our objectives. Perhaps the most important position in the portfolio at the moment, and one of the strongest views, is gold. We have this position both through a core long and through a large range of options which play gold on its own right, as well as through correlation. This is now, by a meaningful way, the biggest driver on the portfolio. So you will see, hopefully, a meaningful asymmetric payout here. The treasury component, it's there and it's relevant in nominal terms, but in practice, the attribution to the risk is smaller, even if our bucket in the 30-year tips has still significant room through both nominal and break-evens to do very well. Volatility perhaps is the second largest contributor to the fund in terms of risk profile at the moment. We have a position in the VIX, both through futures and options. This has been a negative drag for the strategy over the last couple of months, when we added some of these and increased some of this exposure. We have effectively a portion that is long, just core, and some through call spreads. To give you a sense, we've recently initiated a position that is a 40-60 call spread with 20-to-1 payout. So for $1, you could get 20. The attribution of that is by selling the $60 call, you're getting back roughly 80 to 90 cents. So yeah, the 40 to 60, it's a good way for us to stay invested by reducing the negative carry. We obviously have a very significant amount of long-dated volatility risk in Vega, including a 30-year position in FX. Inflation is, you could argue that our exposure to gold is a proxy hedge to inflation. We have other more direct ways, including even a 5-year option that looks for higher equities and with low interest rates, something that the market doesn't really see. The correlation implied in the market is, or the demand is the other way around. So we are trying to take advantage of steepness in the curve and buy insurance where we would make 10 to 1 if the S&P is above 3,200, which is now deeply in the money, and if 5-year rates in 5 years are below 50 basis points. So that's currently about 10 to 1, which we like, and it's an expression of inflation because you're keeping low interest rates to support risk assets. So whilst overall in the short term our core exposure to equities is short, we have some S&P puts, we have some digitals that will pay us 10 to 1 if gold is higher and S&P is lower. We also have, as in point 4, some expressions of equity higher because it's really an inflation play. In the correlation space, I mentioned the gold versus S&P. That has been a very large position for us in 2020. It worked well initially, and then it didn't. In fact, that the correlation being very high resulted in less obvious behavior of the strategy, because when equities were collapsing, so was gold, and when gold was higher, so were equities. So some of that insurance didn't really show its potential, and when eventually correlations broke, unfortunately, was in the wrong direction with the vaccine. But this insurance is there, we have it, and we still think that, on paper, in fact, a blue wave with higher taxes could actually be a trigger. It hasn't been the case so far. But these are very asymmetric options that we like, and they are basically part of our mandate. I mentioned, gold also versus things like euro or the Swiss franc or the yen, where the implied correlation is super high. The market basically thinks the gold and the euro are the same thing. It takes a crisis for those correlations to break, and the asymmetry that you get through this insurance is huge. So days when you might see gold higher and the euro lower, you will see some of these buckets paying. I would say that the last few months have been the opposite and has contributed to the performance in a negative way, because gold, again, following the all-time highs, collapsed, almost 13% or more, whereas the euro just made new highs. So gold in euro has been doing very poorly as a result of a strong euro and weak dollar. But some of these, we think there's good value. We have built a meaningful position, perhaps the most explosive in the portfolio, which is gold versus China and Taiwan. Whilst the amount of premium at risk today is not that high, basically this was a meaningful component for losses in the last part of the year. Many of these options are still alive. There's 1-2 years left, and they're now paying 25-30 to 1. So this could be something that could surprise a lot of people, and that we really like. And in fact, on a moderate basis, we continue to add. Yesterday, we added $60 million of digital payout contingent on gold higher and China lower and Taiwan lower. In the case of Taiwan, this is an actually neutral to positive carry. It's we think a good opportunity, but so far it's been, I think, good idea, bad outcome. We'll see how it plays out, but watch out for China, because this idea that Biden will be super soft and China will do whatever they want is to be confirmed. So with that, I'll have a quick overview, the snapshot of the portfolio in terms of option premium. We have about 22.5% at risk in options, which you can see spreads out. It's actually pretty, we are very heavily exposed to 2021, perhaps more than usual relative to 22, 23. A big part of that is gold. We have a very, very strong view that gold is due for a big catch up, and we will see that. So we are very, very strongly positioned for gold. That resulted in some big gains in the first few days of the year. Yesterday was a tough day. You know, we're playing for the medium long term, so we're going to be a bit more volatile. But we think gold and China and the VIX and all these pieces can offer very asymmetric returns. If you think about this risk in slightly more granular way, you see how that 14.9% of gold optionality, actually part of that is just pure gold plays. Part of that is against developed market currencies. Part of that is against DM. Part of that is against the S&P. So we like gold pretty much in any color, shape, or form, and then we also like the other pieces, as I mentioned. If you think about something that is very relevant, which is also the payoff, this is something that we've adjusted. Last year, tactically, we made the decision, which had the wrong outcome of expressing a lot of the risk through correlation plays. That remains still a good opportunity, but it's now a smaller portion through hybrids. We've increased notably our exposure in more direct plays, which will make the strategy hopefully more predictable and clearly driven to gold. So the exotic call and vanilla call in gold are now together 7.4%, comparable to the hybrid bucket versus which combines all the others. If you see this in slightly more detail, you can see the attribution and also how these hybrids in particular are split over time, but about 5% of those will expire in 2021. I'll conclude with just back to the portfolio and asset allocation, and to basically say that when you're building the team, I think is very important now more than ever to keep the diversification in mind. And when you think about building your defenders and goalkeepers, which is the left side of the screen, I think you need to be mindful that you want to be diversified in terms of defenders, midfielders, strikers, risk on, risk off, whatever. But from an inflation perspective, I think it's very important to differentiate and understand that government bonds, cash, and credit are short inflation. That's why I have them in a red bucket. What it means is that your Telefonica bond that will pay you 100 euros in 20 or 30 years, those 100 euros in 20 or 30 years will not buy you much at all. So this is not a game of nominal returns. It's becoming increasingly a game of real returns, i.e. inflation protected. So with that, we think that, yes, equities, despite the valuations and any considerations you might have, are, in my view, a better striker than credit. I've said this for a while. Clearly, real assets, such as real estate or others, are better than cash, in my view, particularly those who can pay some sort of yield. And I think anti-bubbles and strategies like Igneo or Smart Gold are superior to fixed income in terms of asymmetry and risk reward. So with that, I've covered, the presentation has more sections, including the case study that, how things happened and how they could happen if we had another Q1. The economics and the fee structure and vehicles, which I think most of you are familiar by now, and also the strategy stable return, which is a new launch that effectively combines the team. So instead of Igneo just being the goalkeeper, it has a strategy. This is an important initiative for Quadriga, that it's gaining significant interest, and where effectively Igneo and is one of those pieces. So stable return is designed to compete with cash, credit, fixed income with a low volatility profile. Is looking to make about 5% with above inflation, whereas Igneo could be a huge explosive, hopefully, component that gets us there. So with that, I'm going to stop sharing the screen, and I will open it up for questions. I just looking at the chat. I'm going to start with what's already in there. If you have further questions, please put them there. First one, thank you. Very happy New Year to all of you. There's a question that came direct, which is if monetary policy will remain high, and there'll be a debasement of all currencies versus hard assets and crypto. Yeah, that's right. I think effectively the way I like to describe inflation is most of us think that inflation is about asset prices going up, like my house is going up, my price of bread is going up. The reality is not really the case. It's much more effectively about the value of money going down, and in that sense, it's as you print trillions and trillions of dollars, obviously real estate or anything that you can't print is going up. It's just a function of it's a very simple dynamic. With respect to crypto, I know the very, very smart people are in it, including people like Paul Tudor Jones and Druckenmiller and many others who are notorious traders who understand bubbles better than anybody. And I think they've spotted, like many others, the dynamics. So the fact that they're invested doesn't really validate the investment; it just validates the bubble. I wouldn't be surprised if we saw, we'll see. We could see 100,000. We could see very little. It's going to be super volatile. I personally think it's a dangerous bubble, and as it continues to grow, it has the risk of being systemic, because it's now $1 trillion of wealth that is non-existent. That I think once it vanishes, it shows the emperor has no clothes. But ultimately, this idea of money printing and how people escape, the only reason, and that narrative is there, and is there for a reason. So yes, the continued abuse of monetary and fiscal from government and central banks will lead to real assets. But I strongly favor gold to Bitcoin personally. But be my guest. If you wanted to play crypto or you are in it, well done and good luck. So there's another question on the 60-40, and I get this question all the time, in the sense that or treasuries, and whether it's better to have treasuries or puts or whatever. Look, the issue with the 60-40 balanced portfolio is that if you think about, in Europe, it's more clear because we already have negative nominal yields and nominal and negative real yields. In the US, whilst you have positive nominal yields, inflation is much higher. In Europe, we have deflation. So both are actually in comparable levels of negative real yields. There is a debate on to the extent of how much upside do I have from that fixed income. I think the US, the Fed, will eventually do yield curve control. We'll see US yields going to zero. So I think there's more upside on US Treasuries, but I favor tips to just nominal Treasuries. With respect to should we park the money in Treasuries or options such as S&P puts, this is part of the portfolio. I think there's room for both. and that's what we try to do, subject to these risk limits. There's another question in terms of yeah, again on Bitcoin and institutional money moving. Look, I think there was another tweet from this time a Nobel Prize. It was like, be careful when you follow the masses, because sometimes the M is silent. And look, the fact that people are herding into this and the narrative is there and people are going into it, it doesn't validate, as far as I'm concerned. Again, we could spend a lot of time talking about it. I'm personally skeptical, but even if I had a strong view, it may or may not be necessarily the right vehicle to do this. I think there are probably people who understand crypto way better than me. So my humble advice is prudence. I think this thing is Bitcoin. What I'm going to say is controversial, but I think Bitcoin is closer to Tesla than gold. And I think both could have a 50% down day. Well, maybe in one day is too much, but certainly that sort of level of volatility any minute. So we'll see what happens. There's another comment on gold and silver, platinum, etc. Look, the strategy purposely has a strong bias to gold. We have the ability to invest into silver, which is roughly 10%, but we don't want to be in a situation where the investors think they're into gold and we happen to be long platinum, and platinum collapses because of whatever and gold rallies. So we want to stay, and we'll continue to be heavily invested in gold as a dominant part of the precious metals, even if, yes, we have gold miners, we have silver, we have platinum, but we see these as relative value plays versus gold. And whilst I think they offer good value, we continue to see gold as the main. There's a question on what's happening with gold and the dollar. Why have we had this move? And it's a great question. And to be honest, it's been hard to manage in the last few months. I mean, you've seen some of these big drivers of gold, which are a weaker dollar or lower real yields and higher inflation, etc., which are conventionally strong supporting factors for gold, and yet we saw gold collapsing. Whether it's people giving up on gold and moving into Bitcoin, or whether it's momentum and machine and CTA selling, or whether it's the market just got too carried away in August and we had a lot of weak longs. Whatever the reasoning, the fact is we had this truly major correction which took us way through the 200-day moving average, and it's been a massive cleanup, which I think on the one hand it has hurt gold's credibility as on the one hand, but I think it's also cleaned up the slate, and I personally believe in it very strongly, and I think is arguably best positioned to do what it what it should do relative to the drivers that we're seeing. So I think there's some catch up to be done, but yeah, it hasn't been easy to explain, other than flows and positioning and other dynamics. There's another question once again on Bitcoin and the futures. This is a very good question. Two questions. One is asking about the impact of futures, and the other one about Ethereum. Look, the minute you start having futures on Bitcoin, it kind of kills the purpose, because it just, all the non-printing now becomes levered. So you can have a hugely levered plays through futures, and yeah, the shorts are getting killed and the longs are making tons of money, but it kind of defeats the purpose of not being able to print it. And the second question, which is also very important, on Ethereum, You could argue that you can't print Bitcoin, but you can't print Bitcoin itself. You can print any crypto. So if I'm not mistaken, there's about 10,000 out there. And in some ways, I think the value of Bitcoin is as a winner takes all. And I think the previous move where we had Ethereum and all the other bunch of guys coming up was interesting because it showed you that the emperor had no clothes. He had no clothes. They were all worthless. But this big collapse where virtually most of them went to zero and Bitcoin stayed at 3K, is now almost 40K, kind of joined, all these guys joined forces and just focused on Bitcoin. I think in some funny way, the success of Ethereum will bring back the fact that the emperor is naked, and you have the ability to print infinite amount of cryptos out of nothing. A couple of years, 3 years ago, someone offered me, it's like, okay, you could do your own crypto for 25 grand. I mean, it's like, okay, so 25 grand, not me, but if you are Walmart, for 25 grand, you can have your own crypto algo, and suddenly people paying Walmart tokens, and something that you created with 25 grand is worth 100 billion. It's just completely ludicrous. It's stupid. So anyway, I think enough on this, but it's clearly a big hype. I'm skeptical, but I'm perfectly happy to be wrong. I'm just not playing. I don't think I just think people should be cautious. There's a question on one of the points I made is the virus will go, but MMT will stay. With the new variations of the virus, British, South Africa, etc. How much does the investment thesis look? My point is that I don't know if it's this year or next year or in 10 years. Eventually, we will the virus will be able to hopefully cope with it. Hopefully, and that's what the market is predicting. The point I was trying to make is that it's a human. It's a fact that every single time that we have a crisis, the central banks and governments introduce emergency measures, which effectively are not really, they're sold as emergency measures, something temporary, but they basically stay. Think about QE in 2008. It was sold to us as an emergency liquidity facility and something that everybody was jumping up and down because obviously it was going to create a lot of inflation, or so we thought, and it didn't happen. But QE is now, it's gone from being unconventional monetary policy to very much conventional. Even South Africa is doing QE with non-zero interest rates. It's just ludicrous what's happening. It's just easy, print money, left pocket prints money, lends it to the right pocket, and it just dilutes the currency and creates inflation. As simple as that. So in that sense, I think that all these measures, all this money that is being given to the investors, etc., will not go away and will not be reversed, and we'll continue to have more of the same, which just reinforces the thesis. There's a question on, given the view that higher rates will prick the bubble, is there a way to protect exposure? Yeah, look, that's really what we're trying to do. We're saying, yeah, the market today thinks you can hike rates and nothing will happen. The jury is out. Rates are going up, and so far equities are going up. There's a point at which even through the equity duration, so as treasuries collapse because of rates going up, you have that equity effect also on equities, which also have duration. In fact, very high duration. So the sensitivity to changes in rates. So I think in that sense, we have what we do is try to preempt and try to anticipate and look for the right ways to buy that insurance. So a few more questions coming in. One, whether we will see the yuan blowing up or not. Look, I think the yuan is what happens is, if you try to print and borrow your way out of a problem, then the degree of freedom in the system, what will happen invariably is the currency will go down and you will have inflation. It's Argentina, it's Zimbabwe, it's Venezuela, it's whoever. What China is doing today, and the way they're, what's happening in the yuan, obviously relative to the dollar, it's two opposing forces. I think the credit bubble in China is without precedents. The perception of control and what we do is part of a plan, but it's an incredibly manipulated, incredibly obscure market. And I think one important point about the yuan is that if the yuan is becoming effectively a carry trade, where's the new, okay, where do I park my money? Let's go to China, it's stable, will grow, I earn my 3%. And by the way, the currency will stay controlled. If you believe that, then what we might see is that in the next, if and when we get to see another Q1, which I think we will, the yuan is going to be unwound in a big way, because as volatility goes up, as in addition to the credit pressures and other things. So I challenge strongly the view that the yuan is good money, and strongly challenge the view that it's a safe investment, or low vol, it's a time bomb. So if you play that linearly with Delta One, you can blow up. If you do it with insurance that pays you 25, 30 to 1, I'm happy to put risk there, and hopefully it will pay handsomely as investors need it, because it's not going to be fun if and when this happens. The gold mining exposure we're implementing, we use it as it's basically a relative value between gold and silver and miners and etc. So there are times when the miners are so low that you can replace just gold ETF with a gold miner ETF. We're not, for the time being, pretending to be experts. Even if I'm a gold and I'm a mining engineer, I'm not going to pretend to be a gold mining expert on the investment side, although I follow. But it's a very simple exercise of rotation. So when the miners go much lower, there's potentially good value there, and we rotate out, and we take profits on the miners and go back into gold. So this is something that it's similar to silver in a way that the beta of the gold miners and silver is higher than gold. Another question is coming on our view on China and the peg on the Hong Kong dollar. Look, I definitely think that the peg will eventually break. The dynamics of the peg and the carry and stuff, there are multiple reasons. We've had that bet on the books as a proxy for China, as a direct, as a complement. Some of the options are expiring. I think Taiwan is a superior way, because one is much better carry, and second, I think it's a much bigger problem for and it's going to be much more blatant, partially also because of the impact it has on semiconductors and other industries. Is a lot more strategic. So I do think that the peg will eventually break. Betting against it is tough, and I think if you have limited chips, you need to find the right way, and we've effectively favored Taiwan to Hong Kong. So we'll see how that plays, but there's no imminent reason why Hong Kong would break based on reserves, and what the US is doing is giving further cushion. So question on also how are we doing in terms of AUM and pipeline. Igneo last snapshot was about 340. And we have also 2 SMAs that bring us together close to 400. And this is clearly off the peak, partially because of performance. In terms of inflows and outflows, it's been two-way. I'm pleased to report that a number of investors have been adding on the way down, and I think that's the way to do this. Not taking a strong view necessarily on equities or something, just bringing your weights back to normal. But we also have some people who decided to exit, fully understandable, and for whatever reason. We feel, for many of the reasons I discussed earlier, that the performance, whilst I'm disappointed with the fact that we were not able to hold the capital better in the last few months. I also see that the risks that were out there and the insurance that we owned would have paid extraordinarily. It didn't happen, but also some of this insurance is still alive, and we continue to accumulate, and we liked it when we put it on. It's even better. So I personally think this is a very attractive point to rotate out of risk assets into strategies like Igneo. And I feel very confident or high conviction that some of our option strategies offer will play out hopefully the way we wanted, which is provide very explosive payouts when investors need it. But yeah, in terms of investor base, there's also lots of new people who have been coming in. It's been unfortunate, some of the people that came really at the top or near the top. Some of them have suffered some meaningful drawdown, which starting hopefully to reverse. But I think this, with patience and looking at the overall portfolio, I think these are strategies that I hope and feel that we're very well positioned for what's ahead of us. So there's a question on smart gold. Yeah, for the time being, I tend to refer more a lot of the discussions about Igneo. The numbers are more about Igneo. Smart gold is a sister strategy where the only big difference is that the target weight in gold, instead of being 50, it's 100. The treasury and the option bucket are identical. So de facto, now that we're running a big gold exposure in the options, means they're behaving more similarly. But yeah, it's a strategy that it's non-UCITS. It's available through the DB Select platform, which is great for overlays and to customize solutions. And we run them on a pari passu basis, so very much identical mandate. And yeah, I think both are great. If you need UCITS, then Igneo is better. If you don't need UCITS, I think Smart Gold, it's more volatile because it has more exposure to gold, but I think it's also a great asset. I can see that people are starting to come in for my call in Spanish, which is due to start in 15 minutes. I think I covered most of the questions. If I missed any, please let me know or shoot me a line. I want to reiterate my thank you for all your support over the last few years, and just give you a strong message of prudence with what we're seeing and what might be ahead of us, and to reinforce the view that I think this could be there are very attractive opportunities in Igneo that I hope you'll be able to, and Smart Gold, I hope you will be able to accumulate, and that will do well for you as a team. So once again, Happy New Year, lots of health to everybody, and look forward to continuing the dialogue and at your convenience. Thank you all. Bye-bye.